Let's talk about Target. Over the past year or so, this stock has been on an absolute tear, up roughly 55%. It's basically been the darling of the retail sector turnaround story. And then we get to the highly anticipated Q2 earnings report. On paper, it looked like a total victory lap. But the market's reaction? Well, it created a pretty compelling mystery that had investors scratching their heads. In this explainer, we're going to dissect exactly what went down, piece together the clues, and figure out what it all means for the stock going forward. Okay, let's dive right into this. When the Q2 numbers dropped, the headline earnings per share came in at a staggering $4.11. The analyst estimate going into this? Just $2.33. I mean, that is not just a beat. That is an absolute crushing of expectations. It's nearly double what Wall Street thought Target was capable of pulling off this quarter. And, it wasn't just the bottom line that looked incredible. Take a look at these top line and future projections. Q2 revenue came in at a massive $26.54 billion, handily beating expectations. But perhaps even more importantly, management significantly raised their fiscal year 2027 guidance. They're now projecting EPS between $9.90 and $10.90 down the road. To put that into perspective, the consensus before this report was sitting way down at $8.47. So Target essentially told the market, hey, we are making way more money now and we're going to make way more money later. Which brings us to the ultimate cognitive dissonance of this whole earnings cycle. Target crushed expectations everywhere you look. So why on earth did the stock drop 3 to 4% in pre-market trading right after the news broke? How does a company report a blowout quarter and instantly lose value? Well, the short answer is that expectations were already sky high. But the long answer? That requires us to put on our detective hats and solve this mystery by digging into the hidden details inside the report. Section 1. What Target got right. The clues to success. To understand that drop, we first have to investigate exactly what worked in Target's favor during Q2 and kind of separate the reoccurring successes from the one-time anomalies. The first major clue is this massive number, $994 million. Target actually received a near $1 billion pre-tax refund from the government. These were illegal tariffs that had been collected in the past and were finally returned to the company's coffers. Now, that cash injection alone significantly boosted their gross margins and operating income for the quarter. But here's the brilliant part. Instead of just hoarding that cash or buying back stock, management is reinvesting that windfall directly into price cuts for their customers, driving loyalty right when shoppers need it the most. And this brilliantly illustrates that their strategy is actually working out there on the store floor. Actual same-store sales grew by 3.8%, blowing right past the 2.4% estimate. And what's really fascinating here is that this growth wasn't just isolated to one lucky department. Sales grew across all 6 of Target's merchandise segments, with apparel and beauty leading the charge. Traffic is demonstrably up. More shoppers are walking through those red doors, and they're buying more items. This is a direct testament to the new CEO's aggressive strategy of refreshing 50% of the store's assortment. It is paying off big time. Then there's the margin story. Right now, Target's operating margin is sitting right around 4%. And while that might sound low, it's actually an incredibly bullish context. Historically, Target runs closer to a 6% operating margin. This means that 4% is effectively a trough. If the new management team can continue this turnaround and expand that margin, even halfway back to their 6% historical norm, there is a massive amount of earnings upside still locked inside this company. Section 2. The red flags. Uncovering investor hesitation. So if sales are up, traffic is up, and margins have room to grow, what exactly caused the sell-off? Well, the first culprit is a valuation trap. Target currently trades at roughly 20 times forward earnings. Now, if you compare that directly to their biggest rival, Walmart, which trades at a whopping 41 times forward earnings, Target looks like an absolute bargain. But, context is everything. While they are cheaper than Walmart, Target is actually trading above its own historical average. Investors were basically asking if that 20x multiple was really justified, given the company's unique risks. And when you dig into those risks, a few bearish signals do emerge. First, some valuation models put Target's actual intrinsic value around $130 to $134 per share. That means the stock might have been 13 to 18% overvalued heading into the report. Second, you have classic market psychology at play. Buy the rumor, sell the news. The stock was already up 55% year to date. Investors wanted absolute perfection to push it any higher. Third, we have execution risks. Yes, apparel and beauty are doing great, but home categories, they still need a lot of work. Plus, there's a surprising little fact here. Insiders have recently sold about $8.7 million in shares. While that's not exactly a massive panic button, it's definitely a detail the market noticed. And finally, you can't ignore the dark cloud of macroeconomic consumer pressure. Inflation and higher interest rates are still squeezing the exact kind of discretionary spending that Target really relies on. Section 3. The big debate, bulls versus bears. So we have incredibly strong performance metrics battling against stretched valuations and consumer anxieties. This perfectly sets the stage for a heavyweight fight in the market. The core question is whether Target's progress justifies its premium price tag. The bulls argue absolutely. They point to a proven CEO with a clear assortment strategy, the highly likely margin expansion from 4% back towards 6%, a very comfortable 3% dividend yield providing a nice cushion, and analyst price targets sitting between $170 and $177. But the bears are holding their ground. They correctly point out that a nearly billion-dollar tariff refund is a one-time, non-recurring boost. They see a stretched valuation, intensifying competition from heavyweights like Walmart and Amazon, and the ever-present threat that a strapped consumer will suddenly pull back. Both of these sides have highly valid, mathematically sound arguments. Let's move to Section 4, the verdict, actionable takeaways. We've looked at the mystery, the triumphs, and the red flags. So how do we synthesize all this data into an objective framework? Well, here is the bottom line. If you are an existing shareholder, the data suggests this is a solid hold. The turnaround story is real, and you can collect that nice 3% dividend while you wait for the margin expansion to fully play out. But given the high valuation, it's probably prudent to be vigilant and maybe set a stop loss if you fear a broader market pullback. Now, if you're a potential buyer looking to start a position, patience is your best friend here. The data indicates you should wait for a dip. If the stock pulls back into that $135 to $140 intrinsic value range, it creates a significantly safer entry point. The underlying business story is great, but the entry price just needs to accurately reflect reality. So the crucial point is that you need to know exactly what to track from this day forward. To cut through the market noise, laser focus on these 3 indicators over the next few quarters. Number 1, operating margin. Is it actually trending upward toward that 6% goal? Number 2, same-store sales. Can this new assortment strategy sustain 3% or higher growth once the initial excitement wears off? And number 3, broader consumer spending data. Any weakness on a macro scale is going to disproportionately hurt Target's discretionary retail model. Target really is a fascinating case study because the company is executing its turnaround strategy beautifully right now. But as we saw with that sudden pre-market drop, in today's environment, flawless execution is already priced into the stock. Meeting expectations, even massive expectations, is just no longer enough to send the price soaring. So I'll leave you with this provocative question to ponder. If simply being great is already baked in, where exactly does Target's next big leg up come from?